Welcome back. You're watching The Money Show. We're in conversation with Uday Dhoot talking about investing in smaller sized AUMs, smaller sized mutual funds. Uday, what do you think is the biggest risk when I as an investor decide that, I want to invest in a particular mutual fund which has a total AUM of, maybe that's a little smaller, maybe under 500 crores, or let's just put it at under 100 crore rupees. What do you think is the biggest risk I as an investor could face?
So let's just say, I think when you look at the risk of a small size scheme, it will depend on what the scheme actually is doing. Now, a small size scheme in a debt mutual fund could become risky, like we saw in the last 1.5 years. If there is a sudden credit event and there is an exodus of people leaving the debt fund, then investors who are left might have fairly high concentration in just a few names within the debt. So that's the kind of risk that you will have in a debt fund. Even if you're a small size fund, in a passive fund there is really no risk because the fund is following just an index, right? So there is very limited risk there, barring the cost that you need to sort of think about whichever you get it cheaper wherever, right? When you think about equity, then the question is what kind of strategy is being followed there, right? And what kind of risk can emerge out of there. So I think in general there is no, I would not say that, hey, just because the size is small there is risk, or the size is high there is risk. I think it depends what the mandate is, how the investments are doing, and how the flows are coming to the fund. There could be a small size fund which is getting regular inflows, which are very, very consistent in nature. So size is just one number out there, right? It does not tell us whether it is receiving funds or funds are going out of that mutual fund. So I think all of these things needs to be tracked alongside. Let me sort of now step back a little bit and see that typically when one is looking at, say, and now we are not talking about, say, passive investments, we are talking about, say, active investments. When you are looking at, say, active investments, what are the kind of things that you sort of look? If you look through the literature and the research work around selection of fund houses or fund managers, you will talk about basically 5 P's, right? So there is basically the physical infrastructure, the people, the process, the performance, the price, right? These are things that you are looking at, and then within that you are seeing that, hey, whether am I getting, based on my requirement, is this the kind of fund house which is sort of, where is it delivering, and what are the critical pieces really here is the people, is the process that they have for investment, right? These two are the most critical parts of any fund management. So at times I would want to bet with a smaller fund house also if I know that, hey, the people and the process there are fairly solid, right? The size would not matter. But at times there could be a very large mutual fund, but there are issues with people, and we don't know what is exactly happening, and we have had such issues in the past with certain AMCs wherein the management is not clear, what is happening, who are the people who could. So I think what matters is that what is fundamentally beyond the size. So it is people, process, procedures, performance, what is the price, and then the physical infrastructure. So these are the 5 things that one needs to think about. From a retail investor point of view, size can act as a good filter, right? You would just use size as a filter like we do in many other things, right? When we go out there shopping, if we have heard of a brand, it is easy for us to buy. So I think that's the easy filter that is there for retail investors. But for us advisors, I think there is more work that we need to do to differentiate, and we just can't go blindly and say that, hey, because of size there is performance, or because of size there is no performance.
I think for all our viewers out there who very often have this question that how do you decide if a scheme is right for you, that checklist of sorts that you've given certainly does make that process, the decision-making process, much more simpler. The sort of weightage as well, you should give each and every parameter. I think that's great. Size, of course, it could be one factor, but it shouldn't be the deciding factor. But yeah, those are some of the very interesting features that a fund should have, or essentially parameters, if you could call them that you should judge a mutual fund on. Okay, let's kickstart our Ask the Money Show segment, where we, of course, invite all our viewers. If you have any questions or queries, you can call in 24990300. We've already got a couple of viewers lined up. Let me just go across to them one by one. First up, Aman Chopra from New Delhi is joining us on the phone line. Aman, hi, good evening. What's your question?
Hi, Movina. Good evening. My question is, you have my portfolio on your screen?
It'll come up in just a bit, but still for the benefit of Uday, if you could just sort of reiterate what's on your portfolio.
Okay, I'll speak. The list of funds I have decided. My age is 40 years old, and my retirement goal is 10 to 15 years away.
Okay.
And the question is that I have selected few of the schemes through the Money Control site and your basis on your programs.
Okay.
I have decided few schemes. First is Tata Large and Mid Cap Fund, 15,000 rupees.
Okay.
Second scheme is Invesco Small Cap, 10,000 rupees. DSP Equity Opportunities, 10,000 rupees. SBI Focus Fund, 20,000 rupees. Mirai Focus Equity Fund, 15,000 rupees. And Axis Multicap, 10,000 rupees. Sorry, in case of third one,
I don't think it's SBI focused. I think you mean Mirai focused, right?
One is Mirai focused and another is SBI focused, 20,000.
Okay, there's an SBI focused as well. Okay.
Yes, there are six schemes and the SIP is 80,000. I have started just 1 month back. So I just want to decide. I'll just categorize these schemes through my diversification through the large, mid, and small cap size, in which the large cap is the 50 to 60%, and mid cap is the in between 25 to 30%, and small cap is in between 10 to 20% through my portfolio. I just want to decide that, as the experts say, that shall I add one more scheme because there's one mid cap is missing. So please suggest me going forward what is the future strategy according to my profile as through my age. What will be the future suggestion? And please suggest me one fund.
One more mid cap fund.
Yeah, emergency fund, and one for the short term goal of 2 years.
Okay, so you want something for for emergency, and also you have a more short-term goal as well. That's in 2 years. So these 6 funds that he has, that's for his retirement, which is 15 years later. And yes, he seems to have really been, watching the Money Show, because he's done that split between large caps, small caps. Of course, he's missing a mid cap in the portfolio. So yeah, firstly, Uday, how would you review his portfolio, and any chops or changes that you'd recommend he make? Also, for a goal that's more short-term, that's 2 years, where would you recommend he invest? And of course, for an emergency purpose, for an emergency corpus, do you recommend that emergency corpuses should just be kept away in a savings account, or in a liquid fund? Where would you recommend individuals put their emergency corpus?
Sure. Okay, Aman, just quickly, one thing I wanted to check: have you invested in equities before this, either directly or through mutual funds?
Yeah, I have the 1 year back. I have redeemed all the mutual funds. The corpus is approximately 5 lakh rupees. 1 year back, I have redeemed it.
Okay. So I think before I delve into your specific portfolio and the schemes that you have sort of mentioned, I just want to highlight in terms of the numbers that you have mentioned, and saying that, hey, what kind of corpus will something like this create for you? Now, we did some workings to see that, hey, if you're going to save this amount purely from a retirement standpoint of view, and for how long will something like this last you? And given that, say, you are saying that, hey, I need to retire, say, in next 15 years time frame, and given your existing portfolio and the regular savings that you are planning to make, something like this will be sufficient to cover a monthly expense of, say, 50,000 rupees in today's value, which would be approximately around 1,20,000 rupees during your retirement, right? And if you think your expenses are higher than this or lower than this, then accordingly you might have to increase your savings as you sort of move forward. Now, coming specifically into the portfolio, and what you have to realize is that retirement, when you're thinking about retirement, it is not just about reaching that age of 55 or 60 and so on and so forth, right? It is essentially means that, hey, you get to a stage wherein financially you don't need to work anymore. You could do things that you really are happy doing, and if income comes in, great. If income does not come in, great. So right, so that's the important piece. But from a financial standpoint of view, what it also means is that even if the income has stopped, does not mean that you need all the retirement corpus on day one. So essentially what I'm trying to say is that, let's say you are 40 today, you retire after 15 years or 20 years, then maybe over the course of next 10-20 years you will be actually using up the money. So if you think about it, at 40 you might have almost like a 30-35 year, 40 year sort of a time horizon, depending on half-life expectancies, how good your health is, and so on and so forth, right? So all of these things. So to that extent, when you're investing from a retirement standpoint of view, that is what you need to think. Now, the reason I was asking if you've invested in equities before that is that you might, if you've not experienced equity, what is important to us understand that when you're investing in equity mutual funds is that unlike fixed income products, whether it is PPF, EPF, fixed deposit, some debt mutual funds, the returns in equities are not linear in nature. You will have years wherein you make no money, and then suddenly in 1 year you catch up for 3 years returns, and then suddenly you might lose some of that money. So when you're thinking retirement, when you're thinking equities, which is what your portfolio sort of made, like 100% equity sort of a portfolio, I'm assuming you have some amount of fixed income investments outside of this portfolio to sort of take care of these sort of bumps that happen in the market, right? Now, coming into the portfolio, you have sort of taken a majorly large cap sort of a portfolio with some amount of multi-cap and say small cap fund, and the things that you may want to think about, and what we have seen over the course of last few years is that within the large cap category, building consistent outperformance has become difficult. So maybe if not today, over a period of time, you would want to sort of move away from pure large cap funds into maybe some index funds there, wherein you are not necessarily looking at active outperformance, but you are looking at some sort of an exposure there. So that's the kind of strategy that you will want to look at. I would, if you are comfortable, maybe today add up a slightly more amount of money in the mid and small cap category for you. There are two reasons. One, you have a sufficiently long term horizon right now, and second, mid caps and small caps have had a difficult last 2-3 years, so it might be a good entry point to sort of build some portfolio exposure at a maybe a slightly higher level there, and maybe tune it down as you keep making your additional investments over a period of time. From a scheme set of perspective, I would say 5 to 6 schemes are maximum. You do not really need to add more schemes than that. It just duplicates the effort. So maybe just say maybe a couple of schemes in the small cap category, and one scheme in the mid cap, or maybe in the large cap and the multi cap category, and that should be sufficient. The other things that you may want to think about, and if not right now, but as you sort of build your portfolio over the course of next few years and decades, is that you would want to look at some funds which could give you some exposure outside India, because India is not the only country which has the best of the companies. There are a lot of companies outside India which could give you decent returns. So that's something that you should be thinking about. So what I'm saying is that apart from what you've selected today, maybe as your portfolio sort of grows, things that you need to think about is some amount of passive strategy in the portfolio and some amount of international diversification.
I think that was an extremely comprehensive look at your entire portfolio, Aman. And I hope this will help you in your wealth creation journey, as well as, of course, your more immediate targets as well. Very quickly, I want to take on board one more query. Indrajit from New Delhi is joining us on the phone line. Hi, Indrajit. Good evening. What's your query? Do we have Indrajit with us on the phone line? Okay, unfortunately the phones got disconnected, but let me very quickly take on board one more query. Shankar Sen writes into us saying, I've been investing in equity mutual funds since November 2018, so roughly a year, from before. I want 40 lakh rupees for after 11 years for my son's education, who's currently 7 years old, wants to accumulate 3.5 to 4 crores for retirement. That's after 23 years. So he wants to know if 11 to 12% is a reasonable return to expect from the funds he's invested in. Also, he has a debt portfolio. He's investing in PPF, plus his company invests in EPF as well. So here are some of the funds. There's the ABSL Money Manager Fund, Franklin India short-term bond funds. So these are debt funds. Then there are 2 multi-cap funds, Parag Parikh as well as Kotak Standard, 4,000 each, SBI Small Cap, Axis Growth Opportunities, Murray Asset, all again 4 grand. So I see there's a large cap fund that's more or less lacking. It seems to be skewed towards mid cap, small caps and multi caps. Very quickly, Uday, what would be your recommendation?
See, I think, like I keep sort of repeating, I think what is critical, and this is the message that we need to get across to all our investors and viewers, is that asset allocation, knowing your goals, the horizon is critical. scheme selection is important, but is not really of paramount in nature. If I look at his portfolio, he's got like a couple of multi-cap funds and one mid-cap, one small-cap fund, and another multi-cap fund. So I think I would say that, hey, from a scheme standpoint of view, you're good. What is critical is from a accumulation standpoint of view around the question of kids' education and retirement. Maybe he will have to increase his savings there, and this may not be sufficient for him to sort of reach out to his goals and targets. Considering that education, he's saying 40 lakh rupees, which would be just around 15-16 lakh rupees as of today's value. If he thinks that is sufficient, if that is not sufficient, then he definitely needs to increase his savings there. And especially if it's child education, we also say that you should complement that with some kind of a term insurance for yourself, because that's a goal that you want to meet irrespective of what happens, right? And from a retirement standpoint of view, I think as he sort of his income increases, he should add up to the savings as such. So otherwise, I think the funds that he holds are decent. He can just continue staying there, invested for long term.
The funds are okay. You may just want to revisit the amount that you are targeting as such. Thanks so much then on that note, Uday, for joining in, helping our viewers out with their questions and queries so patiently. That's of course a discussion with Uday Dhoot on essentially small-sized funds and various other questions and queries that our individuals had. If we've not been able to answer your query, don't fret. We'll be back tomorrow as well with a brand new episode where we will be taking on this topic, taxation topics as well. But meet your fund manager. That's the segment that we will move on to. This is the opportunity for all our viewers to listen in to the manager of any mutual fund that they may be owning. So today we will be meeting the fund manager of the Nippon Balanced Advantage Fund. The manager is Ashutosh Bhargava. So anybody who has this fund, listen up. Firstly, I just want to run you through some of the details of the fund. Nice outperformance, nice alpha being generated. 1 year return 9.6%, 5 years 8.6%, and 10 years 10.9%. This is of course the SIP returns as per the latest fact sheet. Banking stocks reign supreme. HDFC Bank, ICICI Bank, Axis Bank, 4 to 2% of the AUM has been put in these stocks. Then you also have some software names. Infosys is 3.37%, RIL 3.2%. HDFC, SBI as well are the other banking names. So largely it's the banking and finance space that does have a decent chunk of the AUM, and then software, consumer non-durables as well have roughly about 5 to 6% of the AUM if you look at the sectoral split. So let's understand where the fund invests, what should a unit holder look out for. We have with us, like I mentioned, Ashutosh Bhargava. Thanks so much, Ashutosh, for joining in. Let's start off first with you introducing the fund to our viewers. Where does it invest? Like I mentioned, what's the objective of the fund?
Yeah, so fund invests both in equity as well as in debt. It is run based on a strategy which is a rule-based strategy. It is a combination of valuation as well as momentum as two parameters for this strategy. Valuation remains the fulcrum of any asset allocation strategy. In our case also, we use a valuation parameter. It is called 1 year forward PE ratio of MSCI India Large Cap Universe. We have looked at the market distribution over the last 20-25 years and have divided the market from very expensive to cheap into 5 buckets. Every time at the time of rebalancing to ascertain the equity exposure for that particular month, we look at where are we standing in terms of the valuation, 1 year forward valuation. Along with valuation, what we have realized that valuations are important, but they are not sufficient to give us optimal asset allocation. And therefore, to have the right asset allocation, we involve another concept of trend following or momentum. So it's a two-factor model. We look at valuation. For momentum, what we look at both the short and medium term momentum. And as you know, the name itself suggests it's a balance advantage. From the advantage you have in this strategy, you can be as high as 80% in net equities, and you can even be below 65% in equities without compromising on the tax advantage which comes up with a equity oriented scheme.
Like you mentioned, there's the equity component, the debt component. So I want to know, how does the debt portion essentially support the fund, especially in these times of, where we're seeing inflation come back. So how important would a debt component be then?
So debt portion is kind of anchor. We does not expect debt to provide significant return. Rather, we consider it as a more conservative strategy wherein we don't take disproportionate credit risk. 85% or more of the debt securities always remain in investment grade AAA. And in terms of duration, we don't run blended duration upward of 3 years. So both in terms of duration risk and credit risk, this is a moderate risk fund on the debt side.
Okay, now coming to the equity side, what's the mix in equity between large caps, mid caps, small caps? Where does essentially the fund invest?
So it being a conservative product, we have decided that we will always keep more than 2/3 of the gross equity portion in the large cap space. At this point of time, 81% of our gross equity exposure is in large cap. However, between now till say 6 months ago, what we have done the last 6 months, we have reduced the proportion of large cap and incrementally increased the mid cap allocation in the fund from 87% large cap. Now large cap stand 81%. And remaining mid cap portion has gone up since this is what we thought that mid cap after a significant underperformance stand a chance to kind of outperform the large caps, and that's why we are incrementally increase the mid caps considering the valuation differential.
Okay, fair enough. Let's also talk then about while there was nothing much that came out from the SEBI meeting, but I must ask you about what does the whole reclassification norm mean for you? Just a reminder for all our viewers, reclassification essentially means what could be classified as large cap, what would be classified as a mid cap, and where can a mutual fund that calls itself a large cap fund invest. Now, SEBI said that they're still looking into it. There was no announcement as such that came about. But let's say if it does go through, what would it mean for your fund? Would your fund management strategy as such stand to benefit?
This fund would be obviously there will be some difference, because if from 100 stock the large cap universe become 125, obviously some bit of flexibility will be available for us to express ourselves well within the norms that we have created for ourselves for the large cap. But as such, it won't make much of a difference as far as balanced advantage fund is concerned. Broadly, the universe will expand, we will have more choices. But given the fact that it will continue to remain a conservative large cap oriented scheme, I think there is only incrementally little benefit if there is any SEBI reject which is going to happen.
The fund as such, they may not be as such so much of a benefit. Maybe some of the other funds that Ashutosh manages may have still some more benefits. Okay, banks and finance, these are an important part of your fund. What makes you optimistic on these sectors? Why do you believe that these are the sectors that would take the NAV forward?
Most importantly, earnings. So 57% of the incremental earning over the next 12 to 18 months are going to come from financials. The combination of the asset write-backs of the earlier provision that banks have made for these stressed assets. So there are a lot of write-backs because of the resolution which are happening thanks to IBC. Other than the fact that there is some bit of pricing power which is also coming to large banks that we have, strong liability franchise corporate banks that we have in our portfolio. There we think because there is a terms of trade shift from NBFC to corporate banks, these banks profitability will be significantly ahead of the market, and therefore we have incrementally added financials in our portfolio, and today it contributes around 41.5% of the gross equity exposure. Along with this, we have within the financial we have a good mix of new age financials and some bit of insurance companies and very select NBFCs, but it's predominantly led by the strong liability franchise banks.
Okay, now Ashutosh, Investors, of course, have this whole past return bias. So I want to ask you two things. Firstly, what should be an investor's return expectation, and also more importantly, rather, the time horizon before he or she considers investing in the fund?
Ma'am, since the asset allocation is done by us, by the model, and this is therefore it's for the very long term purpose. Every time there is a volatility, this fund tends to benefit out of those gyrations in the market, and therefore investor need not worry about the short to medium term volatility that keeps occurring time to time. So this is actually could be the core part of the portfolio, given the fact that not only the returns over the long term are pretty decent, but the risk adjusted return or returns adjusted for the stress that investor take, I think these are pretty high in this kind of category. So I think particularly for conservative investors, they should come for long term and invest, and there is no differentiation whether you come in the form SIP or lump sum, because asset allocation depending upon the market environment is done at our end based with the help of the model.
Okay, great. Ashutosh, always a pleasure having you with us. Thanks so much for joining us on this edition of Meet Your Fund Manager segment. We hope that this has better informed all our viewers on whether the Nippon India Balanced Advantage Fund would fit their profile, their risk profile, and of course help them meet their investment objectives. We will take a very short break, but when we return in our Spend with TMS segment, especially for all those guys who are holding on to their Vodafone SIM cards. If Vodafone goes down under, what does it mean for you? Should you actually then switch over from now itself to maybe an Airtel or Jio, given that those are our only two options? We will talk about that, and of course the latest trends in OTT platforms. Has Apple TV added on more shows? When we return, you will be getting the answers to all of these questions.